Welcome, everyone. In the world of high-growth investing, price is what you pay, but value is what you get. Discounted cash flow analysis, or DCF, remains the gold standard for determining intrinsic value. It allows us to peek into the future, translating projected earnings into today's dollars. Today, we're breaking down the mechanics of free cash flow forecasting. This isn't just about math, it's about building a narrative that supports every assumption. Whether you're a VC evaluating a seed round or an angel partner looking at a Series A, mastering this process is essential for de-risking your portfolio and maximizing returns. Let's dive into the step-by-step framework to master FCF forecasting and find the true value of your next big opportunity. Every DCF starts at the top. To forecast revenue, we look at historical 3-year CAGR and combine it with market TAM projections. For a high-growth company, we aren't just looking at past performance. We're analyzing the sales funnel, customer acquisition costs, and churn rates. Imagine a company growing at 25% annually. We need to validate if this growth is sustainable through market penetration or price increases. A robust model accounts for base, bull, and bear cases. This initial step sets the pace for everything else in the valuation. If the top-line projection is flawed, the entire valuation collapses. We focus on realistic, data-driven milestones to ensure our forecast holds up under the scrutiny of institutional investors. Revenue is vanity. Profit is sanity. Once we have our top-line numbers, we subtract cost of goods sold and operating expenses to find EBITDA. This provides a clear picture of operational efficiency before accounting for financial structures. For high-growth startups, we often look for operating leverage, the point where revenue grows faster than fixed expenses. We track EBITDA margins closely, often targeting a 15 to 30%. EBITDA is a great starting point, but it's not cash you can spend. First, we deduct depreciation and amortization to arrive at EBIT, or operating profit. Then we apply the effective tax rate, standardized at 21% in the US, to find NOPAT, or net operating profit after taxes. NOPAT is a critical figure because it represents the profit available to all providers of capital, both debt and equity. It's the theoretical cash flow of the business, as if it had no debt. This step ensures we are comparing companies on an apples-to-apples basis, regardless of how they are financed. By removing the noise of interest and capital structure, we focus purely on the core earning power of the company's operations. Growth isn't free. To sustain that 25% revenue increase we projected earlier, the company must reinvest. We start by adding back non-cash depreciation and amortization, then subtract capital expenditures and changes in net working capital. CapEx covers the physical assets and tech stack, while working capital ensures there's enough liquidity for day-to-day operations. For rapidly scaling firms, working capital needs might consume 5 to 10% of revenue. This reinvestment phase is where many investors find red flags. If growth costs more than it earns in the long run, the valuation will collapse. We analyze the net reinvestment to see how much cash is actually free after the company pays for its own future growth. We've reached the core of the DCF, unlevered free cash flow. This is the cash actually available to be distributed to investors or reinvested. The formula is NOPAT plus D&A minus CapEx and changes in working capital. This number is unlevered because it ignores debt interest, focusing purely on the core business's ability to generate cash. When we see positive and growing FCF, it signals a healthy, scalable business model. For early-stage companies, this might be negative initially, but the path to positive FCF is what we are modeling over a 5 to 10-year horizon. This metric is the lifeblood of valuation. It's the actual reward for the risk taken by the capital providers. Most of a company's value lies beyond the 5-year forecast. This is the terminal value. We typically use the Gordon growth method or an exit multiple to estimate this forever value. Simultaneously, we determine the weighted average cost of capital, or WACC, which serves as our discount rate. If the WACC is 10%, we are essentially saying that $110 next year is worth $100 today. We discount all future FCFs and the terminal value back to the present. The sum of these discounted values gives us the enterprise value. This is where the risk-reward profile of the investment becomes mathematically clear. It represents what the entire business is worth today, based on every dollar it will ever make. A model is only as good as its inputs. A 1% change in WACC or a 0.5% change in terminal growth can drastically swing the valuation. That's why we perform sensitivity analysis. We test various scenarios to see how sensitive the valuation is to key drivers, like revenue growth or margin expansion. As VCs and investors, our job is to find the margin of safety, the gap between the intrinsic value and the current price. If the valuation holds up even under stress, you've found a winner. Mastery of DCF isn't just about the final number. It's about understanding the levers that drive value and having the confidence to back your conviction with rigorous data. Thank you for joining this masterclass on FCF forecasting.